Hello, everyone, and welcome back to the GMS Weekly Podcast, where we break down the key developments shaping the global ship recycling markets.
It's week 17 of 2026, and whatever hopes the market had for resolution, they've now been firmly pushed aside.
Exactly. Last week, we were talking about a ceasefire extension, but now it's been extended indefinitely.
Which sounds stabilizing, but in reality, it's done the opposite.
Because while the ceasefire is technically in place, the situation has escalated sharply. We've seen vessel attacks in the Strait of Hormuz, reported seizures, and the U.S. naval blockade of Iranian ports remains fully intact.
And importantly, the timeline has shifted. Mine clearance in Hormuz is now being estimated at up to 6 months.
So what was once a short-term disruption is now clearly a medium-term constraint.
And that changes everything.
It does, because the idea of a near-term reopening of the strait is effectively off the table.
And markets are reacting to that shift.
Oil has reversed direction this week. Brent is back up near the mid-90s, not on demand concerns this time, but on renewed geopolitical risk.
So the narrative has flipped again.
Exactly. We've gone from war premium cracking to risk reasserting itself.
And freight continues to tell the clearest story.
Strong and still climbing. The Baltic Dry Index extended its rally to multi-month highs, with Capesize earnings now at 4-month peaks on sustained Brazil to China flows.
Which keeps vessel earnings elevated.
And that's the key. As long as earnings hold, owners will continue trading rather than recycling.
So once again, no incentive to release tonnage.
Exactly. And currencies are reinforcing that picture rather than changing it.
Right. We're seeing a weaker rupee, a stable Pakistani rupee, Bangladesh holding its range, and the Turkish Lira hitting fresh lows.
But none of that alters pricing dynamics in a meaningful way.
So the macro picture is actually very clear.
Elevated geopolitical risk, firm freight, and stable currencies, all combining to keep tonnage out of the recycling market.
Which brings us back to the same core issue.
Supply.
Still not coming.
And now increasingly looking like it's being deferred.
Let's move into pricing, because structurally, the rankings haven't changed.
Bangladesh remains number 1, Pakistan second and firming, India third and softening, and Turkey still at the bottom.
So the hierarchy holds.
But the underlying momentum is becoming more pronounced.
Let's start with Bangladesh.
Bangladesh is in a very strong position right now. Steel prices are steady, the currency is stable, and importantly, the LC pipeline is clearing at its fastest pace since the post-Eid reopening.
So financing constraints have largely eased.
Exactly. That was a major friction point through Q1. And now it's no longer the issue.
And compliance?
Still very much in focus. Those sanctioned VLCCs at Chattogram continue to cast a shadow, and due diligence has now become embedded practice across the market.
So everything is aligned. Pricing, financing, compliance.
And urgency. With about 5 weeks left before the monsoon window closes, time is now the key pressure.
But despite all that,
No ships.
still,
And that's the problem. Not demand, not pricing. Supply.
moving to India. And the story hasn't improved.
No, it hasn't. The rupee continues to drift weaker, and the Hormuz situation is now even more disruptive.
Because of energy exposure?
Exactly. Around 90% of LPG and roughly 70% of crude imports are still tied to Hormuz routes.
And with the strait effectively constrained.
Those disruptions continue. Steel prices are holding, but not enough to shift competitiveness.
Which keeps India as the lowest-priced destination.
Correct. And once again, it's not about capacity. Alang remains highly compliant, fully capable.
But still waiting for vessels.
Exactly.
Now, Pakistan, and this is where things are really strengthening.
Definitely. Pakistan is probably in its strongest position of the year right now.
Pricing is firm,
Very firm. Steel prices are holding at high levels, the currency is stable, and recyclers are operating with a very predictable cost base.
and geopolitics are working in Pakistan's favor.
They are. The escalation in the Gulf has fully reinforced Pakistan's proximity advantage.
So that's no longer a marginal benefit.
Not at all. It's now a structural premium. Tonnage exposed to Gulf dynamics is increasingly favoring Gadani.
And with more HKC-compliant yards coming online,
Compliance, pricing, and logistics are all aligning at the same time.
but even here,
Same constraint. It all comes down to whether vessels actually arrive before the monsoon window closes.
and right now, that's still uncertain.
Exactly.
And finally, Turkey.
Turkey remains unchanged. The lira has weakened further to fresh lows. Inflation remains elevated.
But none of that improves competitiveness.
No, pricing remains far below subcontinent levels, so activity is limited to EU-regulated tonnage, where compliance overrides price.
So no real shift there.
None.
What we're seeing now is the Q1 overhang starting to roll into a Q2 backlog, and with the monsoon window narrowing.
That backlog risk is only increasing.
So the question has evolved.
It has. It's no longer just whether supply arrives before the monsoon.
But how much of it gets deferred beyond it?
That's all for this week's update on the global ship recycling markets.
We'll be back next week with more insights.
Until then, stay safe and see you next week.